Hi guys, welcome to SavvyMoneyShow with me, your host Sean. Today we're starting with a company that it doesn't matter whether you're a value investor, a dividend investor, a short squeeze chaser, or if you're just looking for something to protect yourself against tapering. The company we're looking at is Big Five Sporting Goods Corporation. Spoke about this before. It was a good dividend, which you've just missed, I'm afraid, 5%. I did notify you beforehand. It's named in the top 10 gun stores in the country. It's had blowout earnings. I said pre-earnings it would, because Under Armour had great earnings, and Under Armour has a partnership with them, so a lot of their stuff goes through this company. It also has a load of other partnership. Has a market cap of 470 million versus an enterprise value of 655 million, a trailing PE of 4.58, a price to sales of 0.4, 1.68 price to book, enterprise value versus revenue 0.56. Now it's one of the top 10 shorted stocks in the market, and we had a short squeeze before and we played that. I think it's one that you buy and hold until the squeeze comes. You just keep gathering the dividend until then. The dividend will keep reducing your cost basis. Now we're going to go to, don't forget to hit that lovely like button, and don't forget the sexy subscribe button. A lot sexier than me, just ask the wife. And if you want to be a hero, hit the bell notification. You'll be notified when a new video gets uploaded. And why not check out the links in the description below. If you're looking for a free trading platform, you get a free share worth up to £200, depending on the platform you use if you deposit a small amount. Absella. I spoke about it in my Discord and on Twitter. Basically, the company is a biotech company, and they IPO'd at $70. They're down to under $15, and they are an AI powered antibody discovery platform. Now Pfizer doesn't discover their own drugs, they partnership with the companies that do. And what happens is that this company has partnerships with some of their partnerships are with GlaxoSmithKline, Eli Lilly, and they have a massive amount of other partnerships, including Teva Pharmaceuticals. I suggest you look into it. I think this is the bottom. If it gets back to 70, there's no guarantee it will get back to $70, but if it does, that's a massive gain for us. Again, I think this is one buy, and you just hold for your when you buy it and leave there until it does what you want it to do. Sorry, no more fingers and thumbs. And but it has a PE of 23, which shows it's profitable, and it's constantly discovering new drugs, which it takes a piece of. Now, I think the chart looks great. Sorry, but you need to decide for yourself. Anyway, IONQ came down to $18 again. I picked up over 100 shares. Reason why I was upset that I was selling call options on sold a call option to bring down my cost basis. Rookie mistake on a company you have high conviction in, because it got called when it hit 30. And I sold it for $20. This was when it was $10. Now, granted, I made a lot of money, but not as much as I could have. When it came back down to $18, I took my chance and I made some. This is the real thing. On Reddit, the head of Air Force Research Labs, Quantum Tech, says US, Canada, New Zealand and Australia are collaborating on quantum applications for unaided navigation encryption, and the small size of IONQ's processors and lack of need for cooling, which is done by lasers, will allow them to be mounted inside aircraft. Now, if you want a copy of this, I have it in my free Discord, links in the description down below. There's also news about the qubits coming out. There's nothing but good news about this company. I don't know why it's not higher. It seems to me like it's being shorted or is going to be tax harvesting. I think in January, once people buy back in after the tax harvesting, this will fly. And I'm still maintaining my price targets. I do think 5 to 10 years this is going to be $1,000 stock. Now, EVgo, which I spoke about before, I like this because I've actually privately invested in a company that makes the solar panels for them. It goes on top. I can't say too much about that, but the market cap is lower than the enterprise value, which for a growth company like this is rare. I know the price to sales is high, enterprise value versus revenue is high, but JP Morgan has classed this as their EV stock to watch. Energy stocks will be the ones to watch with the CPI data coming out, in my opinion. And the thing about these is they're fast charging. I know myself with an EV vehicle, one thing stopping people getting an EV vehicle is they don't want to be waiting for hours to charge it up if they go low. Now, the faster the charger, the better the chances of someone buying either the charger or buying an EV vehicle. They have a massive amount of partnerships across Europe and the US. They are still under $13. I do like their business. If you're comparing them to ChargePoint, and remember it's apples to oranges, I like both. I would own both in my opinion. ChargePoint is a safer play. ChargePoint has the software where they'll be making more money as software as a service, but EVgo can implement software and bring it in. But these guys have the faster charging already implemented. But as I said, it's not either or. You can have both of them. But it's good to have the backing of JP Morgan in it. And as I said before, ChargePoint, and I said when it was $18, $19, it is a safer play because it has one of the best, one of the biggest charging networks around there, and they've had good earnings. They've increased across most levels. I do like it. I've liked it since the merger. The market cap above enterprise value is to be expected. But another one, and I've spoke about it before, Tritium is the one who supplies the chargers for ChargePoint, and it's still under net asset value. They're merging with DCRN, and they've just unveiled their groundbreaking line of EV fast charges. And one thing to say about EVgo, to add on, is that Chevron have just signed a contract with them to have them put into their stations, because if you're going to have declining revenue from your petrol stations, it's good to diversify. The Chevron will probably get tax breaks for doing that, and EVgo is also suited for fleets as well as cars. Anyway, that's all for now. Don't forget to hit me with a like button and subscribe if you haven't, and I'll see you in the next video. If you found any of my videos helpful and you want to help me make more, you can support me by buying me a coffee. The link is in the description below.